So we touch on the following the structure. So we touch on the market beta. Okay, so let's explain what market beta is. Assume your portfolio beta is 1.5. All right, your beta is 1.5. Okay, so for example, if the general market goes up 10%, your portfolio is up 15%. So beta is a measurement on how correlated you are with the market returns. Okay, so if you're 1.5 times, means you'll be moving 1.5 times either up or down according to the market. So if, for example, if the market goes down by 20%, your portfolio should be down by 30%. So that is the definition of beta itself. All right. But beta is just a rough measure because beta can always be, it's quite dynamic, it changes. So your portfolio beta is not always a fixed number. And what is useful is that you have always heard this, right? If you buy stocks over the long run, right, should have higher returns than bonds. Okay, so this market beta is trying to explain if you invest in stock market versus if you invest in, say, bonds, and because the two authors are based in US and most of the research are done in US market, and that's why they compare the US stock market with the US Treasury bill, which is like a form of bonds, a short-term bond. All right, so if you invest in the US stock market for the past 70 years, about then, based on their research time frame, and versus you invest in US Treasury bill for the same period, the portfolio with the stocks will be higher than the returns from the Treasury bill by 8.3% per year. Okay, so that's a very substantial returns if you invest in stocks. So that's why it's a lot more lucrative. But they also give the caveat and says that, you know, but there's no free lunch in investing. So if you invest in stock market, there's up and down, right? Whereas when you invest in a Treasury bill, it's always up, it doesn't come down, and your base is always your par value or face value is always there, right? It's anchored, so you won't have any volatility being experienced. So what they did was, one of the emphasis for the authors were, they put out a probability of outperformance table, as you can see here. Okay, so what it's trying to say that if you hold a pure US stock portfolio, right, you in 1 year you have a 66% chance of beating bonds. Okay, so you still have a good 34% that you may not beat bonds and get lower than bond returns. And 3-year, 5-year, 10-year, 20-year, as you see, as they extrapolate out into a longer period of time, you can see that the chances of stocks beating bonds have increased. That means that being a long-term investor in stocks will give you a higher chance of doing much better than if you have invested in something that you feel safe, and there's a lot higher chance that you get higher returns. All right, and this is a good basis. But you can see that some people don't like it, right? Imagine I hold a stock portfolio for 5 years, I still have a 18% chance of not beating the bonds, and that feeling really sucks, because people would have expected, 2 or 3 years I should have a higher rate of return than I would have put in bonds. So that tells you that there's no free lunch in investing, and that is the risk of underperformance that you have to experience when you invest in stocks. All right, so which means that periods of underperformance would force an investor to give out on stock very easily, and this is very true, because based on our experience when we interact with investors, it is definitely a reflection of the real life, because we always hear investors when they hold a stock portfolio for 2 years and they don't see any much returns, then they would have, let's say, from the bonds market or even CPF returns. Okay, they will feel very upset. They'll feel that, this stock investing doesn't work at all. Okay, but actually 2 years is just a drop in the ocean, and in the long run, as you can see, the odds of beating the bonds returns is a lot higher when you invest in the stock market. So how do you capture market beta, right? So that brings us to the broad market index ETFs. So major indices like S&P 500, you can just buy the exchange traded fund. You can buy the Vanguard Total World Stock. You can buy the STI. If you have exposure to Singapore market, you can also buy KLCI ETF in Malaysia. So these are some of the examples that how you can actually capture market beta. So you may not just want to buy bonds. Having some exposure to stock market on the long run should help you do better than you would have with just bonds.